Imagine you're a stock investor. You don't want to sell the stocks you own, but at the same time, you know that markets can be volatile and you'd like to protect your portfolio from downside risk. What can you do? There are several strategies available to you, but here's one you may not have considered: hedging your risk with equity index futures. This can be done in either brokerage or retirement futures accounts. Here's how it works. First, identify the index futures you'd like to use for the hedge. For a broad-based stock portfolio, the CME E-mini S&P 500 and E-mini Dow are two different products which represent the broad market. Additionally, the E-mini NASDAQ represents a tech-heavy portfolio, or the E-mini Russell 2000 for small caps. It depends on the type of stocks you're looking to hedge. Second, calculate how many futures contracts are required. To do this, divide the total value of your stock portfolio, say $280,000, by the notional value of the equity index futures. You can look up a future's notional value on eTrade.com, but you can also calculate it by multiplying the current value of the underlying index by the future's contract size. For example, if the S&P 500 is trading at 2,800 and the contract size of the E-mini S&P 500 is $50, then the notional value of the E-mini S&P 500 is $140,000. Long story short, in this hypothetical example, you'd only need 2 contracts of the E-mini S&P 500 to hedge your entire stock portfolio. Last, establish your hedge by selling the futures contracts, essentially placing a bet against the direction of the underlying index. If the market goes down, the amount you lose from your stocks would be generally offset by the gains in the short futures position. The net effect? Likely little change in the value of your portfolio, even in the event of a steep market decline. Of course, the same is true in the opposite direction. The futures hedge would roughly cancel out any gains the stocks might generate in a market surge. It's important to note that this is an approximate hedge. It's not perfect. The offset amount of the gains, or losses, from the futures hedge will depend on how correlated your portfolio is to the futures index you use as a hedge. For investors looking to manage risk, equity index futures can be a powerful tool. They give you the opportunity to slow down the roller coaster ride of the markets for a while, without needing to make changes to your underlying portfolio. And once you're ready to reassume full risk, you can close your futures position by buying back the contracts you sold. Want to learn more about futures or add futures trading to your account? Visit us today at eTrade.com/futures.